The last method we're going to talk about tonight is the internal, or today, whatever, the internal rate of return. And so this is also a discounted cash flow model and starts with the proposal's cash flows and then works backwards from there. So we've got in our example the cost of new equipment of $33,530. We've got our expected cash flows of $10,000 a year. Machine's going to last us for 5 years, and we expect, or we need to get more than 12% back in order to do the project. So following the so we look at the net cash flows for 5 years, and using the present value from the annuity table at 12%, that gets us to the 3.605 present value factor. And then that tells us that our annual cash flows from this project will be $36,050. We subtract from that the initial investment, and that gets us the net present value for this project of $2,520. Again, because it's positive, it is more than the 12%, and we can sort of guesstimate through trial and error at what interest rate would actually bring that in equal to the $33,530 cost of the investment using the present value of the cash flows, and that would actually be 15% that is actually returning for us. And again, here is how we do the 10,000 annual cash flows at the 15% present value, and that again was a trial and error. The book authors just went to the table and used an educated guess to kind of narrow down what they thought it would be, and that would get us to our investment, which tells us that the project is actually paying us 15%, which is more than the 12%, which is what we wanted. So when we're going to get equal cash flows from the project, the internal rate of return is much simpler. It's the amount to be invested divided by the equal annual net cash flows, and then you go to the annuity table and do as we just did. Let's look at another example. We've got a cost of a project, $97,360, and the cash flows that we expect, the expected useful life is 7 years, but note that it doesn't tell us what the interest rate is that we expect to receive from this project. So we're going to find that here by going to our 7 years, and then we're going to use the calculation to determine the present value of the annuity factor by taking that cash investment of $97,360 and dividing that by the annual cash flow. And I'm just going to hop back to that just so you see where those numbers came from. So here's our numerator, here's our denominator, and what do we get? 4.868. Well, what is that? Well, if we go to the 7 years and we follow that over here, that tells us that we are at 10%. So that's sort of backing into getting us the factor from the annuity table by calculation rather than knowing the interest rate and the time period and then finding the factor. This is knowing the time period, having the other information, and then calculating the factor, which then tells us the interest rate. So much like the present value method, it looks at cash flows, considers time value of money, we can rank proposals, but also like the net present value, it's more complicated and makes assumptions that may not be valid. So I'm going to just slowly scroll through these. If you want to pause and work through them, you're certainly welcome to do that for extra practice. Uh, so let's say we do these calculations. We come up with a number. That's merely one factor in many that could crop up that might impact the value of a project. And so here on your slide are a myriad of factors that also could complicate our decision-making process. And the first one is income taxes. Now, we might estimate what the income tax effect is of a particular project, but remember, we are forecasting well down the road. And Congress makes tax law, and they could all of a sudden decide that they're going to change the corporate tax rate, or they're going to change what kind of depreciation can be taken on a certain kind of machinery. And that could just entirely blow our calculations out of the water here, because now our assumptions that we based our calculations on aren't going to hold true. And when it comes to comparing two projects, they may be similar in some ways, but may have different depreciation schedules because of tax purposes. So that may complicate things. And so here's an example of that. We've got a company that's considering buying a new truck or a new computer network. And here are the numbers. And so one's got a cash flow that's going to come in. They're both the same amount of money, same amount of interest rate, two different useful lives. And but yet we get to this same bottom number here in the end because the cash flows are the same, but they're definitely not over the same time period. And if we were to look at this using the net present value models of the two, we can see that looking at the truck, it has a net present value of $12,060, whereas the computer is $16,805. But so because these have two different useful lives, we're comparing apples and oranges, which we can't do. If we were to revise the truck to a 5-year useful life, now we can compare, now we're comparing, even though it's computers to trucks, the fact that the useful life is the same means that we're looking at the same period of cash flows, and now we can compare these two, and now it becomes more apparent which would be more advantageous for us, and it's the truck by $1,835. A decision that companies often have to make is, does it make sense to buy the equipment or does it make sense to lease the equipment? And there are pros and cons to each of those. And to some extent, you can use this analysis in that, but there are all kinds of uncertainties that can crop up when you're looking at any sort of analysis on this along these lines. I mean, what if the revenue that we're counting on in this cash flow analysis doesn't actually show up? What if we don't get the cash flows? What if they show up differently than we calculated? These are all projections, and if they don't hold true, then we did our best. We tried hard, but our numbers aren't going to pan out the way that we had projected, and hopefully we've built in some cushion for that. We don't necessarily know what's going to happen with inflation, with the economy, with a pandemic. I mean, there are companies all over the world that are, trying to get their bearings because, with the pandemic, based on supply chain problems, based on the chip shortage, which has its own separate origin outside the pandemic. There are so many factors that have impacted companies, and the degree to which they didn't build in much cushion to their projections, they're most likely facing bankruptcy at this point. We have foreign exchange rates. If we are dealing in a global economy and we are dealing with currencies of different countries, we are somewhat at the mercy of what's going on economically in a country that we don't have may have a limited business presence in. And so we've got to build some factor in to deal with the potentials for exchange rate changes as the dollar strengthens and weakens against foreign currency. There are also qualitative factors. Just because a project looks good on paper doesn't mean it's going to be good for our company. It may not fit with what our company culture is. If taking on this project might make sense on paper, but if our employees are already working overtime and this project is going to mean that now they don't, get weekends off for the next 6 months, that's going to be a problem. And that wasn't calculated in any of these factors. So there are lots of qualitative reasons that don't show up in any of the calculations that a manager certainly needs to consider before taking on a project. So, there's a concept called capital rationing, and this is kind of where I'm going to wind up our talk today. And so as a manager, as a business owner, funds are not unlimited. You've got to decide. You've got to ration your cash and decide. You can't take all the projects. So you're going to have to figure out what makes the most sense. And you're going to basically triage those projects and start initially with the non-discounted cash flow methods that we talked about at the outset today, the cash payback method and the accounting or average rate of return method. If those yield positive results, then you can go to the next tier in the analysis, which are the discounted cash flow methods. But if your project doesn't pay itself back within the useful life of the equipment, it just gets scrapped at the outset. Now, it doesn't mean that you can't come back and revisit it later if circumstances change, but we've got to have some method of allocating limited resources among a variety of projects and kind of using this, tiered analysis. And this is just a graphic which says basically what I just said, and gives you a bit of a decision tree for, accepting or rejecting when you've got choice with, when you're faced with choices of multiple projects. You also want to conduct a sensitivity analysis. So what that means is you want to know the extent to which the numbers that you have relied upon might shift if there's a change in any of the assumptions. So you've got a result that was based on a set of assumptions. How different, if the reality is different from your assumptions, how different can it be before your end result turns out not to be a favorable project? And so you want to know what that is. You want to know where the cash flows result in that make that project unfavorable. So if that's what starts to happen, then at least you can sort of assess the likelihood that that could occur. And if it starts to happen, at least you've got a forewarning that you might have to change course in the middle of this project. And so here's an example where, we're looking at cost of equipment of $2,500,000, which is going to have a residual salvage value of $100,000, and they're expecting annual cash flows of $600,000, useful life of 8 years, desired rate of return is 15%. So based on the $600,000 annual cash flow at 15%, we end up, after subtracting the amount that we're going to invest, at a net present value for the project of $224,900. Now, what happens if the cash flow isn't the 600 that we hope for or need it to be to get the $15,000 return? What if it's 5,000 or 500,000 or 400,000? Well, then what happens? So you can see that the total present value at 400,000 is appreciably less than 500, which is appreciably less than 600. And after we subtract out our investment, then what happens? And I should say these two numbers here should be negative. So these aren't even producing a positive return, let alone the 15% that we insist on in order to do this project. So do we just, run away at this point? Do we say, oh man, boy, I need that 15% or I'm not doing this? Well, if that's the case, then maybe you do run away. Well, before we run away, we should figure out at what point, how much of a margin of safety, how much of a cushion do we have here before this project becomes a loser? So let's calculate that. And we know that if we make no money, we break even. We basically just cover our costs. We've whatever that annual net cash flow is divided or multiplied by the 15% present value factor. If we add back in the residual and subtract our initial investment, that gets us to zero. That tells us that's what our break-even point is. But what we need to know is, what is that annual net cash flow? So we're going to do a little algebra and shift the initial investment and the residual value to the other side of the equal sign. And that comes out to be 2,467,300. We are going to divide that by the present value factor. And that's going to tell us what the annual cash flow is that basically gets us to not lose money, generate a positive or at least a zero cash flows greater than, I should say, 549,877 will generate a positive. The 549,877 will generate a break even or a zero cash flow. So obviously anything more than that is certainly preferable, but isn't going to hit until we get to the 600,000, the return which we insist on. So how likely is it that any of those scenarios will happen, the 400,000, the 500,000, or the 600,000? Because there may not be an equal probability that if we're just as likely to have cash flows at 400,000 as we are at 600,000, that's a pretty big risk that we're either going to make money or lose a lot. And if the chances are even, perhaps the risk is too great, but maybe there are factors which will allow us to weigh those. So here we have this scenario, and we've determined that there's a 70% chance that we're going to get that $600,000 annual cash flow. 20% it's 500,000, 10% it's 400,000, all adding up to 100,000. So now we can multiply those by the cash flows, and that gets us the expected value at the probability of occurring. So this is the kind of the weighted probability of cash flows. And then we can go back and plug that number into the present value calculation. And that tells us that based on the probability of a weighted probability of this, we come out positive at 45,420. And at the 15%. And so at least based on a weighted average of possibilities, it still may, we still may be okay, but as they say, your mileage may vary. Actual results may not turn out exactly as predicted, but that's just one method of weighting these various scenarios based on the probability that of the outcome of any of them. And that concludes Chapter 12.